Good afternoon, everyone. Thank you for taking time out today to join us for, I guess it's the 2026 outlook. It's the first quarter outlook. With me, obviously, is Jason, who you all know. And quite startlingly amazing. I would have predicted it would be clear blue skies today and sunny and probably warm. When you're in Toronto, you guys have record snowfall there, right, Jason?
It's a lot of snow, school day. My son was home all day. He built a ramp in the backyard to do a little skiing. And so he had a pretty good day.
That's right. You guys have bunny hills there, right? Not the real stuff out here.
Yeah, not the real stuff.
Well, for those of you in Vancouver, hopefully get out and enjoy some of this weather. Again, I'm startled given how much rain we've had the last couple of months. Anyways, the title day is with rose-colored glasses. I think there's two different ways you can look at it, and I think it points to where we're at in this market, which we'll get into. So if we want to move to the next slide here, our good old disclaimer. And by the way, we will be sending copies of the slides out to everybody along with the recording. And at the end, there'll be a short survey. I'll probably remind you again about the survey. If you can fill it out, it really helps us with improving our presentation and how we communicate. All right, I guess I'm getting pushed along here. Is Eileen the one that's working the thing this time?
No, no, I'm the one pushing you.
Okay, all right. Before we get into this year, let's just have a quick look at last year. I think the two things that we really tried to hammer home last January was expect more volatility. 2024 was an unusual year where we didn't see a 10% correction. And of course, the volatility did come in an unexpected way, but just as quick as it came, it seemed to pass. And that was obviously Liberation Day was the big volatility move earlier in the year. And then the other part is that we had a bullish outlook, which we still do, and we'll explain why. And that was really on the basis of, the most important thing, and that's combination of corporate earnings and economic conditions being good. Just to recap a few predictions that we make, and again, for those of you that have talked to me enough times, I adamantly explain the difference between forecasts and predictions, but what's a fun presentation without having some predictions? So last year, prediction of 10% correction in markets after we hadn't seen 124. 2024 was correct. Inflation staying high, correct. The Fed will not cut interest rates. I'd say half correct. I think we were expecting to see more rate cuts, and that didn't happen. The conservatives win a majority. When we were talking in January, Jason, last year, I think the liberals were at almost an all-time low, and it seemed like
Yeah,
it was impossible for the conservatives not to win.
yeah,
But hey, this is why they're predictions, right?
yeah.
Capital-friendly Canadian government attracts U.S. investors, pushes loonie to 80 cents. That definitely didn't happen. Utilities shine is what we saw more power deals. Absolutely. We're going to get into talking about the whole AI boom and particularly in productivity and how that's affecting different sectors, including energy. We threw a few ones out there like Tesla buying Uber. Again, didn't happen, but we did see robo-taxis. And they've been rolled out not only in the United States, but in other countries in the world. The TikTok ban and being forced to sell to X. Did see that, but I think they're being sold to Oracle, if I'm not mistaken. But it's hard to keep track these days of some of the geopolitical headlines. And then copper being the best performing commodity, almost got that right. It was second best performing. Gold was the best performer last year. So, anyways, enough with predictions. Let's talk about the outlook and key points for this year, Jason. What are we seeing?
Yeah. Yeah, so a lot of the themes that we saw in 2025 will persist through 2026. For those that watched Friends and enjoyed watching that sitcom, really the setup for 2026 couldn't be any better, to quote Chandler Bing. We are expecting the market to continue to be driven by investment by firms and putting a lot of money into building out the artificial intelligence, building out the data centers to support that, which will support earnings not only for tech companies, but also for the broader market. Yes, valuations are elevated. That doesn't mean that the market has peaked. It does mean that volatility will be higher. So when you have markets that are expensive and you get some sort of headlines, it spooks investors and you have that greater volatility, which we saw last year. And so we expect the same this year. We do begin to start to see more of a broadening trend. So less focus on the tech stocks and more of investors focusing on the adoption of AI across the broader economy. And we could see, some companies that can show that they can adopt artificial intelligence and have the productivity gains. We could see some significant share moves in those companies. We have a nice tailwind from the Federal Reserve lowering interest rates throughout 2026. Expect one or two more cuts throughout the year, depending on who the Fed chair is. We have financial stimulus coming from the Big Beautiful Bill. We do continue to see this K-shaped economy. K-shaped economy, if you think about this, is we have one part of the consumer that's doing well, that's the top of the K, and one part of the consumer that's not doing very well, which is the lower income earners. We do expect that those lower income earners will get a bit of a benefit from the tax cuts this year. And so that could be a nice surprise to the bottom part of that K, which could surprise the upside.
Which already is looking pretty good. I mean, we're talking about almost 5% GDP growth in the US. I think in my entire career, I don't think I've ever witnessed that happening.
Yeah,
So
yeah, you're talking about like Chinese GDP numbers in an economy that's not controlled by a central government. So it's if we do that, hit that number, that that alleviates lots of concerns about the amount of debt that the U.S. is racking up, and obviously also is good for alleviating concerns about the elevated valuations in the equity market. Um, and as we kind of move throughout the year, we do expect the volatility, like we said, this is a more of a feature of being late in the bull market rather than a signal on the peak. Um,
foundation of tomorrow. Well, I'm going to leave it
yes,
to you on this one.
yeah,
By the way, that was an AI graphic we used.
yeah.
Uh,
We had to clean it up a little bit because the
AI
AI
doesn't know how to spell
misspelled.
yet. Yeah.
What did it misspell? I can't remember.
Foundation. It was like all garbled. It's great with pictures, but AI is still learning how to spell properly. So
Yeah, yeah. So looking at the secular trend in artificial intelligence, so this chart illustrates how much the large tech companies have been spending on building out the data centers to support rolling out artificial intelligence. So you can see it's been ramping like a hockey stick, particularly 2024, 2025. It continues to grow in 2026. But if you look at the rate of growth, it is slowing. So from 72% to about 30% this year. So it's a really, the second derivative, you have slower growth. And so we think that investors will start to look elsewhere. Not that tech's not going to perform well in 2026, just that we think that there'll be more of a broadening as investors look to see who's going to be the beneficiaries of adopting this artificial intelligence. So we're
oh,
looking in the power infrastructure, healthcare, and industrials.
yeah. And I was just going to add that, I think too, investors will start looking at this sectors that, again, we'll get onto it later on in the presentation that have been less interesting or less appealing from an investment standpoint that as things broaden out from tech itself, as Jason said, I think presents some excellent opportunities, which again, we'll talk about later in the presentation.
So just kind of looking at the adoption of artificial intelligence across the broader economy, you can see looking at conference calls, we've seen a sharp ramp up in the number of companies that have been mentioning AI or adopting AI within their business practices. So what's the net effect of that is that we're seeing an uptick in productivity. Um, so an uptick in productivity, better for earnings growth, good for inflation. And again, speaking to like why the setup looks so good in 2026 is if we do get this productivity boom, it takes care of kind of these inflationary pressures. It continues to deliver on the earnings growth. And you can see by sector where we're seeing the most adoption. Professional, technical, obviously within technology, financial services, and real estate. And so we think this trend is going to continue throughout this year. Just a couple of highlights of where we've seen it. So this is from our last presentation, Western Digital, saying they've started to adopt some of these processes within their manufacturing. IBM said they took about a 3.5 billion of costs out of the business by adopting artificial intelligence. JP Morgan just announced that they're replacing the proxy firm that votes their shares with artificial intelligence. Thermo Fisher, which is a name held in the portfolio, is using AI within their laboratories. And so you are seeing this across many sectors, and we will continue to see it kind of broadening throughout this year. AI is the business cycle. You can see looking at this basket of artificial intelligence stocks has really outperformed the S&P 500. You can see how much AI leaders have been contributing to S&P earnings. It's almost half of the earnings for the S&P 500 last year. Again, we'll see a similar trend in 2026, but the market, investors will start to be looking at these names. So the earnings expectations have been coming down for the rest of the market. So we think there's probably an opportunity for a surprise to the upside. And you can see that in this chart. So this is the estimates for the Mag 7 for 2026 earnings. They're expected to grow about 20% in 2026. The rest of the market, and this is a typical pattern, you see that earnings estimates move down throughout the year. And then what it ends up happening is that the companies end up beating these lower estimates. But you can see the rest of the market growing at about 11%. So really, still really healthy earnings growth. Obviously not as good as 20%, but we think there's a surprise to the upside on that lower number.
And listen, it's still double-digit earnings growth, which is great when you look at 493 companies in aggregate. Earnings are growing quite nicely, which again bodes well for share prices.
Yeah. So Seth, maybe you can talk a little bit about how we kind of look at the markets. A lot of people have been, or at least late in last year, there was a lot of talk of the AI bubble and the market peaking. Maybe you can walk us through why we don't think we're in a peak yet.
Yeah. Well, I mean, just on on the AI bubble comment, I think it really needs to be renamed. AI is the business cycle, because I think we need to stop thinking about AI as an investment itself. It's the business cycle, right? And there's a whole bunch of data points and charts and what have you that we've obviously go through and look at, and we just thought we'd grab a couple of these ones. So the first one here just shows the credit spreads, U.S. corporate bonds, a 10-year spread to governments. Again, doesn't really point to any recession. When you see it peak there in those red lines, that's when recessions, bear markets happen. The next one is, when it comes to interest rates, and again, we have other charts that will be come up as well, but essentially the short on this is when the Fed is easing, it's hard to get a bear market. It's typically when you start to see the hiking that bull market starts to get squeezed. And again, we're in a rate cutting cycle. The last one here is just investor sentiment. We don't have a lot of excited investors out there. I think people still have memories of other big drawdowns, even the pandemic, 2022, for longer term investors, 2008. And just because we've seen such a big run up in the market, there's probably a lot of caution and bearishness when it comes to where can this market go? And obviously headlines play a role. I mean to say that we're not affected by headlines, I think everybody is to different degrees. It's what you do with it. And obviously the headlines these days are quite a lot more graphic and startling. And from an investment standpoint, they maybe don't matter as much, but they do at some level, I think, affect investors, which again, that's good for us. People generally are not bullish. Here's another one too. This here goes back to the 1800s. I think this is an interesting one because this looks at past bubbles. So railways in the UK, the Dow in the 20s, obviously 1929 crash, the Nikkei in the 80s, which took several decades to recover from. The Nasdaq .com and obviously since the 2020s here. I think the important thing is that in the previous four, to the point I made earlier, is that you need to see financial conditions tighten. Part of that tightening includes the Fed hiking, not cutting rates. And again, we just are not there yet.
Yeah. And so each of these red lines represents periods when the financial conditions started to tighten. And so you typically see the market continues to run up and then it has some trouble. So it'll be once the Fed starts to tighten, that'll be kind of a yellow flag for us, signal to start to get a little more cautious.
Yeah, and listen, part of the reason for tightening will be, looking at inflation, right? If it starts to look like it's actually kind of reversing and gaining some momentum, the Fed's going to be there to try to keep a lid on things. So, all right, this is an interesting one. So again, I think the bears will point to, well, valuations are high, we're at a peak, they need to come down. Yeah, listen, you're right. Absolutely, valuations are high. And as Jason said, this is part of what's going to add to increased volatility this year. But you got to remember, if you're growing earnings at 20% in terms of tech, or even 10, 11, 12, 13% in terms of the rest of the market, some of that can go away just by the fact of increasing earnings. I think the other bear comment I often hear is how much of the market is controlled by the top 10 stocks, which are basically tech stocks. Right now, it's about 40% of the S&P returns are driven by 10 companies. I actually, just before this presentation, had a look to see Ned Davis, who does some great research for us out of the US. They pointed out in Canada right now, the top 10 companies are about 45% of the TSX. And in the UK, the top 10 companies make up 50%. And in Europe, depending on which market, can be 60 or 70% top 10 companies. And you get looking at peaks, you look at the TSX, for example. I think back in 2000, when you had Nortel and Bell Canada take over the index, it was almost at 70%. So not that it isn't concerning that you have 10 companies that are driving most of the return, but relative to the rest of the world, it's actually not that off. In fact, it's less than those markets I mentioned. Okay, so here's another one, just again, talking about, corrections that we can see and around volatility. Again, 2024 was a special year. We really didn't see a correction. 2025, we obviously saw a pretty healthy one and a few little minor ones. But if we're in something like, what we saw with the internet being the business cycle back in the 90s and bringing on productivity, if AI is that equivalent now, we're probably somewhere around 97, 98, ish. But you can see that there's been some pretty healthy corrections along the way. So again, these aren't things to be scared of. These are actually opportunities. But this also comes back to asset allocation and things like that, which we'll talk about later on, because picking the right stocks at the right times is what helps make the difference. Right, Jason?
Absolutely.
And here's just another one. Again, there's lots of data points Jason and I look at. This just looks at energy prices for American households. So, one of the biggest things that everybody needs or has is a car. And outside the people that have electric, the people that have to fill up their tank obviously can hit their pocketbook. Again, this is just interesting to see that gas prices are at the lowest level they've been in 5 years. And I just saw recently they're probably going lower given some of that Venezuelan oil that's being dumped into the U.S. market. So again, good for the consumer, keeps them grounded in spending, and again, doesn't point to that there's any stresses at the moment. Jason, yeah, I mean, this is your line. Let's make it 4 out of
Let's
a
make
golf
it
term.
4.
But I mean, do you want to walk this? I mean, it's pretty straightforward to show that quite easily we could have another year or two of positive returns.
Yeah, I mean, it's just a simple comparison to what the market did back in the internet bubble, ahead of the internet bubble, and what were the kind of returns we've seen since 2023. So yeah, I think people are concerned that we can't have another double-digit year. Um, History would say, given this kind of secular AI trend and how transformative it should, and I think it will be to the broader economy, history would suggest that we still have some good, healthy returns ahead of us.
So we have the S&P 500 here because this is a market that frankly matters. From worldwide market cap, it by far is the biggest in terms of in terms of market share, and it's also the one that kind of gives the direction, frankly, to the rest of the world in terms of the course of the investment. So what you see here is three columns. Jason, do you want to kind of just quickly walk through the
Sure.
bear,
Yeah.
base, and bull case on this one?
Yeah. So our base case, 7,750. So that would be about 11% return. And if you remember, if you look at earnings growth for the broader market, it's about 11%. So, we think the market will just perform in line with earnings growth. Uh, the upside to that estimate is if we see really artificial intelligence take off, the adoption, the productivity, if sovereign and governments start to invest heavily into artificial intelligence, I think that could really give another leg to those tech stocks, and that's kind of when the irrational exuberance may kick in. That would be the bullish case, and then the bear case. One of the bear cases could be there's just not enough power demand to meet building out all these data centers, and so that could crimp some of the growth. That could cause the kind of the AI trend to sell off. We could see stagflation, so high inflation and low growth. I think this one is more of an outlier. I would be leaning somewhere in between these two cases as a more realistic scenario.
Yeah. Canada, we can't have a presentation without talking about good old Canada. So obviously, I had an interesting year last year. But Jason, do you want me to kind of jump on kind of what drove that? But what our thoughts are around
Yeah.
those particular
So
sectors.
yeah, if you look at the return composition of the TSX last year, really it was the gold miners that drove the TSX. The material sector was up almost well over 80% last year. Um, so, we talk about concentration in the US being driven by tech. Well, Canadian market has been driven by gold stocks. And we know that gold stocks can be highly volatile because they're price takers. And so, yeah, good year for the TSX, but we don't want to put all our eggs in one basket. Definitely in those kind of commodity price taking companies. Canadian banks did pretty well for the TSX as well. Um, you know, Credit provisions, credit losses were pretty benign. They always obviously have quite a bit of reserves to handle an economic slowdown in Canada. And what we really saw kind of the multiples expand because the worst case scenario really didn't play out. you know, Areas of where we think could perform well in 2026. The sentiment on oil is pretty negative. We did get a bit of a lift on oil prices because of the what's going on in Venezuela, which is kind of surprising, thinking that, the amount of oil that Venezuela would be able to pump would mean more supply, which would mean lower prices. But it's really, 2 or 3 years away. There's so much infrastructure that needs to be built out in Venezuela to get that oil really pumping. And there's also the questions about whether those U.S. companies really want to give it a third try to see if they can build the infrastructure without the assets being seized. Um, and so, surprisingly, the sentiment, well, not surprisingly, but the sentiment's pretty negative on the oil industry. The good news is that the supply demand imbalance moves into balance in 2027. So I think investors are starting to get the idea that, maybe it's time to be adding some energy exposure.
And just on this chart here, just what that orange line shows is basically record short positions are looking at record short positions accrued versus managed money. So that is something significant. Maybe jump to the next chart because I think this is also, this came out on a Raymond James presentation. chasing you attended. But again, like I mean, the sentiment is worse than it was in 2014 or even in 2020 when we had negative oil. I mean, that's incredible, right?
Yeah.
Um,
Seth, you were talking to one of the analysts. He had an interesting comment.
okay. Yeah, I was going to say when we talk about the
Oh, you're
portfolio,
going to say
but
that?
no, I can talk about it. I mean, no, he was mentioning that for the first time ever in his career that he was actually seeing mining fund managers um, you a little bit nervous because they were up so much, obviously, last year that they were taking some profits and buying energy stocks as a way to kind of play it safe, so to speak. And the other thing we both agreed was, it's been a long time since you see energy stocks in Canada going up and crude prices aren't going up. In fact, we saw crude prices go down and we've been seeing, some of our favorite names like CNQ and Whitecap, have been continuing to gain a little bit of momentum here. So it's something that, again, um, there isn't a headline that's spelling this out. And again, investor sentiment is horribly negative, but that's also sometimes when the good money's made is looking at some of these sectors and looking at the dynamics of it. And again, we'll talk about a little bit later on why we're weighting more into energy.
Yeah. And typically in Canadian energy sector, you get paid to wait because they offer pretty healthy dividends.
But I know the next slide is a cautionary tale of what goes up can go down rather massively
Yeah. Yeah. So while the
on the
TSX,
TSX.
yeah, TSX obviously had a good year in 2025, driven by material stocks. The TSX can have wild swings. I mean, we looked at the three biggest sectors in the TSX and looked at the max drawdown over the last 25 years. So the material sector, your max drawdown was down 66, energy down 90%, still hasn't recovered from 2006 levels, which is crazy. But that max drawdown, which happened in 2020, was when oil went negative. Obviously, good bounce back here. And then financials, that was the great financial crisis. Almost down 60% was your max drawdown. But in more normal times, you know, financial sector drawdowns typically 20, 30%. Um, I think we all know that the Canadian economy is challenged. Per capita GDP is among the lowest of OECD. Canadian firms aren't investing. I'm going to go out on a limb here and say the Canadian economy avoids a recession in 2026 and things actually get better and the Bank of Canada hikes interest rates once. Um, I think that, well, we'll see how the trade Kuzma goes, but I think Canada, US kind of get closer together and a lot of that tariff stuff um, goes away or is
Well,
least resolved.
I think the big news today, as much as perhaps the U.S. won't admit it, but definitely would have caught their attention is the fact that Carney got a full welcome there in China with the Canadian flag up over Tiananmen Square and stuff. Um, some people would joke, well, see, that's just a socialist welcome another socialist into Tiananmen Square, but I think that's pretty material because for the Chinese, it's all about saving face and what have you, and the fact that they welcomed after such a acrimonious engagement over the last probably decade with Canada. I got to believe at some level the U.S. recognizes, do they really want to lose Canada, particularly our oil to the Chinese?
Yeah, yeah, yeah. I think that they're obviously thinking about that, and we'd both be better to get together, having a closer relationship rather than us looking across the ocean. So,
Well, they will, but the U.S. will never say uncle.
yeah, yeah.
And we're too polite to force them to as Canadians.
All right.
Um,
So, an outlook without headwinds, Seth, is not an outlook.
I
So,
know.
bring us the headwinds.
Another interesting AI. Our first go around on it, AI couldn't spell the word inflation and spell tariffs wrong and what have you. But yeah, it's a nice little picture, but it kind of sums up, at least visually, all the things that are kind of being bantered about on the headlines, things to think about. I think the one on the right, is probably the most worrisome if that ever come back is inflation. But maybe we can just jump to stuff that you're going to hear more about. So like next this year is midterms in the U.S. What that is essentially where half of Congress and I think a third of the Senate is up for reelection. And right now the Republicans control both houses. And so obviously, um, you're going to see a lot of probably headline stuff to try to gain votes from both Democrats and Republicans. Historically, midterms haven't been a horrible year, but they just haven't been great. I think the average there, is 4.5% or something like that for the S&P. But I think the point we make later on is this big, beautiful bill that was passed back in the summer. A lot of those tax cuts are going to start kicking in for individuals. And so, when people have more money in their jeans, putting the geopolitics aside, they typically feel better. And they typically vote for whoever it is, they deem to be putting the money in the jeans. Now, will that happen this year? Honestly, I don't know. I think it's a flip a coin as to what happens exactly. But the point being is that there's low expectations going to this year for a big year, which is all the more reason why, if those earnings expectations hold up, we could end up with a pretty healthy year as we drive through things, albeit with more volatility. Yeah, another little AI picture that, again, did you actually correct the spelling yourself in that picture?
No,
Finally
there
took
was
AI to
there
figure it
was
out.
uh there was a word here that I had to erase. I can't remember what it was.
Okay. Anyways, like I said, great for pictures, but again, can't.
Well, they didn't get the dollar sign right.
Yeah, that's right. Here's a few known unknowns, and we only bring them up because we never want to be completely dismissive of things that are out there and say, "Oh, that's not going to be a big deal. It couldn't happen." It suddenly turns into one. And so we're well aware of these things. I think they're both positive and negatives on the markets, depending on which way it goes. Things like the government shutdown. I mean, I think when you put that one in there, Jason, it was a couple of weeks ago. We're halfway through January. I haven't heard anything on that one. I think the Fed independence, that's a big one. It's very important that the central banks are seen as independent of, the federal government, and can make decisions appropriately. And obviously, anybody that's seen the news lately knows that, some of that's been called in question. I do believe, though, at the end of the day, the Fed will remain independent. I just think that it's just too important not to be. The ruling on tariffs, I think market could go either way on it. Markets come to adjust to Liberation Day and what came after, including the taco trade, as they say. And so I think that, again, it's something to be aware of, but I'm not so sure that's going to, rock markets or anything like that. The big one for Canada is obviously the USMCA negotiations. At this point, we're not really hearing much, but I think that's actually probably a good thing. Less is more. In other words, if this was being back and forth being talked about, I think there's more worry that things could go off the rails versus, quietly getting a deal renewed. We call it reordering of global order. I don't know what else to call it. I mean, everything from NATO to, Greenland to what's happening in the Middle East. Yeah, there is a reordering going on. There could be a slip there. Again, it's a risk, but not one that we're spending a lot of time thinking about. An upside risk, right? Like what could drive this market to that, that 9,000 on the S&P and have more eye-watering valuation? Well, all those negative investors suddenly get really excited coming to the marketplace. Economic growth, right now it's at 5%. But if it keeps going, too much economic growth becomes quite inflationary, which is the big one that we're concerned about. And then, consumer consumption, right? As the market goes up and their portfolios are worth more and the tax cuts come in, there's more money to spend, you generally feel wealthier. And so, I think that it's just, again, these things you have to watch, but I don't think you want to spend a ton of time worrying about. Let the data take you there, right? Okay. Portfolio overview. I know this is a market outlook, but I think it's good to touch on our two main asset or our two main portfolios, our fixed income and our Cadence Select. Um, so I know it's probably a little bit hard to read because it's hard for me to see the percentages. It might be the fact my eyes are a little bit dry, not that I need glasses, but um, just walking through it, I think this kind of lays out how our portfolio currently sits. So you can see that we have a pretty good weighting in healthcare, energy, industrials, financials, and tech. Um, we're also within even those sectors, but in the other sectors as well, taking a barbell type strategy where we're looking for defensives that give good dividend yield, offset against companies that have good growth, such as prospects and will do well in this economy that's growing right now at 5% in the US. I think that the key here won't necessarily, well, I mean, stock picking is important, but I think, the key here for Jason and I is to get our sectors right this year, because I think that, the fact that, tech has been such a big winner over the last couple of years, we're already seeing it starting to underperform. So the question is, what are the next sectors that, we want to be looking at? And we're going to touch on those for you. But before we get to that, I guess a little bit of, so for those of you that have been with us since we started the pool from the SMA, the SMA has been around for 10 years, 15 years plus, but we created a pool about 2.5 years ago. As of Tuesday, we were officially up 58.08%. You missed an eight in that eight. So yeah, no, it's pretty good, Jason. I think it's something that, and I think we did it in a cadence-like way. We didn't take a ton of risks. We didn't use any leverage. As you saw back on the tech side, I think we're about 15% tech right now. We're not 40%. So
Yeah.
we didn't do it by, betting the farm on all the tech stocks with that kind of volatility. We did it, I think, rather humbly and in a cadence-like way. And again, that's what we do. Okay, so talk about sectors. Jason, do you want to kind of get into like some of the names we picked up? And like I love this one on healthcare because it just got me so excited when I saw these charts. And I know we've been talking about healthcare for the last couple of months. And do you want to maybe kind of touch on why we
Yeah.
went into more
Yeah.
healthcare?
So just kind of looking at healthcare, it's very underowned among investment managers. And interestingly, like healthcare is one of the largest spending components for US consumers. So we think the sentiment's kind of washed out there. It's a lot of interesting names within the sector. We started to see the behavior in that sector looking a lot better from a technical perspective. You can obviously pick up some decent yield there as well. So we've added a couple of names to the portfolio. Boston Scientific is a med tech company, good balance sheet, good return on equity. It's kind of been trading sideways for the last little bit of while, and so we picked that up in the last couple of weeks. Thermo Fisher involved in scientific tools for testing and making pharmaceutical drugs. That's actually been a pretty good performer for us since we added to the portfolio late last year. Amgen we've held for quite a while, so that's our kind of biotech way to get exposure to biotech. That's been in the portfolio for well over a year, so we've been adding to that name. And then on the pharma side, Bristol Myers trading at a sub 10 PE with a dividend yield of about 5-6%. So
In fact, when we bought that, the dividend yield and the price earnings multiple were
was
the dividend
higher.
yield was higher. Yeah, which
Yeah, which
I
has happened
rare.
never.
I've never
It's
seen
never
that
happened.
before. Yeah.
Yeah, so we've been adding to healthcare. I think that sector, from adoption of artificial intelligence, we could see some nice productivity gains in there. And just from a valuation perspective, and from like kind of the sentiment being washed out and the charts starting to look a little better, we've been adding to that sector. Additionally, we added Eaton recently. So they do have exposure to building out these big data centers, but also they have obviously they're involved in industrial, so building out manufacturing. So any kind of reshoring that we see in North America, would benefit that name as well. Again, good company with strong balance sheet, good return on equity, and valuation was looking pretty good. And the name kind of looked washed out. And they're coming out of a heavy capex cycle, so we should expect some nice dividend increases or share buybacks from them. United Rental, kind of similar theme in industrials. Uh, Expect them to be performing well as U.S. economy sees 5 or 6% GDP growth. So they should see some uptick in terms of rentals of their lifts and some of their industrial rental units. To fund those recent additions, we did take some profit on Alphabet, Google, and Home Depot. A little less excited about the U.S. housing market, although Trump did make some announcements recently about buying mortgage-backed securities, which might get the Canadian or U.S. housing market moving. But Home Depot has kind of been stuck in a trading range, and we haven't seen a lot of movement in terms of home sales in the United States and affordability. So we took a little bit of profit on that and rotated in names that we think had a little more upside.
Yeah.
Yeah, go ahead, Seth.
Oh, no, go on. Sorry.
And then a relative switch trade that we did. We've owned Walmart for about a year and a half, so we sold out entirely of Walmart. I was trading at an expensive multiple. And then Costco, we've held for a while. It's been underperforming. The price to earnings multiple converged on the two. We looked back on when that happens, and typically when that happens, Costco outperforms Walmart. So we sold Walmart and added the proceeds to Costco. And then on the U.S. consumer play, we added to Walt Disney.
Because we're predicting Apple's going to buy them, right?
And we're predicting Apple will buy them.
And the last thing I just again, just if it's a little bit hard to read, that chart on healthcare in terms of how much consumers are spending, actually goes all the way back to 1929. So to see like the fact that healthcare is such a big part of spending today is significant. The chart to the right again, if it's a little bit hard to see, is showing that that in terms of the ownership as a percentage of the market cap, it's the lowest it's been since 2000. So like when you see a sector completely underowned, and you see spending in that sector to be one of the biggest components for consumers who make up the biggest part of the U.S. economy, an economy growing at 5 or 6%. I don't want to say it's a no-brainer, but it seems like an obvious sector you got to own more of, right?
Yeah, and then just talking about sentiment again. So yeah, oil looks interesting, or energy look interesting based on the sentiment, and similarly, healthcare positioning sentiment late last year was pretty negative. It's obviously ticked up here with some of these or pharma companies performing a little bit better in the new year.
Risk management. You want to kick this one off?
Yeah.
I mean, yeah. Okay.
Go ahead. Oh, you go. You go.
Oh, okay. By the way, we do this remotely. We're not in the same room, folks, for some of you that may not realize it. So we have to do a little bit of mind reading sometimes. Yeah, no, I mean, I listen, again, I have a thing on the back of my wall in a frame from Benjamin Graham. Look, you manage risk properly. That's ultimately what's going to drive long-term returns. Sure, you can get lucky and pick a handful of stocks or get into a certain sector, and you suddenly feel like, oh my gosh, it's all about finding the best return. No, it's really about managing risk, and how we go about it. I think it's quite that's what there's no black box to it, but I think how we think about it is very different than most people, which is I think what also has led to our cadence-like results. So maybe Jason kind of walk through a little bit about just some of the stuff we do in the risk management side as a reminder.
Yeah, and I'll just say, so like the Canadian Select Equities medium risk. So what does that kind of mean? I mean, we have guidelines on how we want to invest, and we have guardrails. So we can't put 80% of the portfolio in tech. We have certain amount how much we can put in tech. So we're properly diversified across all sectors. So we're not swinging for the fences. We're trying to get base hits here, multiple base hits here, and get to home in a safe way. So diversifying across sectors is one way that we mitigate risk, not putting all our eggs in one basket. So yeah, great if you'd known that gold was going to go up 80% this year and you bought all the gold stocks, that's phenomenal. But then if you're all in gold stocks and you have a big correction, that can be obviously pretty, pretty hard to take. Our core satellite strategy, so we categorize our names based on are they core holdings, and core holdings tend to be companies that have high return on equity, free cash flow, pay a dividend, are leaders in their space. And satellite names tend to be names that we rent. So something that has more volatile earnings profile. We think there's an opportunity there, but wouldn't want to be holding that name in perpetuity. Their option strategy adds to smooth return by collecting premiums. Now, obviously, the volatility right now has been pretty low, so the premiums that we can get on options is not great right now. So if you look at the portfolio today, there's not a lot of options in there right now. But throughout most of last year, we were writing against a lot of the names in the portfolio to generate that extra return.
And I also believe that, the option strategy definitively adds return while lowering risk. So it's something that really makes sense with what we're doing.
Yep. And then clients who are more risk adverse, obviously having that added layer of fixed income can smooth returns and lower volatility. Speaking of fixed income, Seth?
Yeah. Yeah. I was thinking about it, I'm like, should we have done the slides the other way around? But it's fine. And I think the reason why we went through that risk management page, again, some of you may have seen some of it. It's just a reminder there's going to be more volatility this year. And also too, like when we show the TSX, some of the drawdowns you see in materials or gold, those are the things that we definitively look to avoid. And so we have the fixed income mandate, which has been around for I think 12 or 13 years. Over that time, it's done roughly 5.5% a year, which, again, is right in the upper end of kind of where our target is for it. Um, uh, it's now set up as a pool, much like the Canadian Select Fund. And a lot of the reasons that we set up the fixed income pool is just the benefits that we already knew we were getting from the equity pool. Better pricing on things like foreign exchange, institutional level pricing when it comes to funds that we use, some additional income opportunities, simplified tax reporting. So for those of you that hate all the tax slips that come every year, it's one tax slip. And the Raymond James risk rating on it is low risk. Doesn't mean it's no risk. It just means it's low risk. And I think that, again, for somebody that, maybe, either can't sleep well at night with all equities or, is looking to pair some little bit more safety in a portfolio. I think this is a great mandate. As you can see on the right here, it lays out, the credit rating distribution. So we're not in all in high yield, for example. And I think it pays a pretty decent yield to maturity of 5%, given that, interest rates are what they are in Canada. So predictions, not forecasts. Jason, do you want to kick that
I'll
off?
take the first one. So I think I already mentioned this. We made concession on USMCA, deepen relationships with the United States that removes any tariff uncertainty in Canada. Canadian economy surprises the upside. So does the Canadian consumer. Bank of Canada raises rates 25 basis points in the latter half this year, and the loonie hits 76 cents.
Yeah, I think that's the one prediction that I'm not hearing anybody talk about. So,
Yeah,
but it kind of makes sense, though, right? I mean, if we got a deal done, Canadian economy does better, the Bank of Canada decides to hike rates a bit, and with energy prices and energy stocks doing well, you get the loonie picking up again. Yeah, the second one, listen, this whole AI theme is a business cycle. Look, don't be surprised, again, it's a prediction, but to see big government announcements about investing in this part of the business cycle, which obviously could really supercharge those Mag 7 that make up 40% roughly of the S&P 500. And on the backside of that is the issues around electricity. So the same analyst I was talking to about energy, he's actually in Netherlands right now. He's about to have a baby boy. His wife's there. She's from there, and we were talking about that exact thing. The electricity market in Belgium or Netherlands is a complete mess. I mean, to a point where the government had to step in and literally start writing checks to people because people couldn't afford their electricity bills. And so I think that I think this is a kind of big one. I don't know if it's going to happen next year, but depending on how much this build out happens and obviously the great demand from AI, the power that's needed, it could be something that goes from a prediction to a forecast at some point. Jason, number.
Yep, yeah. Leveraging AI, we see some major breakthroughs in medicine and energy technology. This is what will cause the irrational, exuberant phase of the investment cycle to start, and we'll see tons of investors piling in, not only to the tech stocks but every other part of the market.
Yeah, and if you recall, that happened on a lead up to the dot-coms when General Electric even got into the dot-com world of things and stuff, and GE became a very hot stock to own. For those of you who remember, Nortel, Bell Canada. Anyways, we're not there yet. On the commodity front, yeah, $5,000 gold. I think that's an easy prediction because we're almost there. One thing I do remind people though is, as much as I think we're in a bull market for gold, you could see a singularity event that it easily could see a 50% correction in the price. It could be something as simple as Trump orders Venezuela to sell off their gold reserves to pay for the U.S. invasion or the attack that they did when they grabbed the president. It could be just something that one of these one-off events that could cause a pretty good correction. I don't think it would take away the bull market in gold at the moment, but it's just something to be aware of. And then, I'm going to go for round two. My call is copper is going to be the best performer. I started my career on copper. At the time calling for $2 copper when it was 88 cents and having compliance, down my throat saying I'm crazy for making those words, which is almost laughable today when you see where it's trading at, at a record high. I kind of gave that one away. Apple buying Disney.
Yeah, and you got the last one.
Well, okay, all right. Well, okay, we're gonna go for round two on Elon Musk too.
Yeah,
Him and AOC didn't quite see eye to eye. They haven't hooked up as a couple. But Elon Musk becomes the first trillionaire this year with all of his companies. So that's our forecast. Let's get to the bottom line to wrap this up here. All right, live your cadence. Look, 2026 is definitely set up to be a good year. Rosy, as we've named it. For those that will find out in a little bit, you'll see where that connection is in my personal life, but we'll leave that for right now. A lot of this is going to be driven obviously by AI as a business cycle and what that's going to do to earnings and what have you, which we've talked about. But expect higher volatility, and a lot of that higher volatility is going to be driven by some high valuations, particularly in things like the tech sector. So it's going to be a balancing act between growth and what that valuation ought to look like. I think, in terms of performance of other sectors, we've highlighted energy and healthcare as two that we're quite bullish on, that I think that have been under-owned for years and have low investor sentiment. That could provide some pretty decent returns. And some of that is going to be driven by the AI business cycle. Obviously, the Federal Reserve, when they're cutting rates, that's good for equities. It's a tailwind for both the stock market and the economy. But as Jason talked about, this K-shaped economy probably will persist to going into this year. And again, it's unfortunate that not everybody is participating in this great growth we're seeing in the United States. Again, it's possible with some of these tax cuts and stuff that lower end of the K will get more benefit, particularly from some of the things around no tax on tips and overtime and things like that. But it is something that I think from a social standpoint, maybe not at midterms, but maybe at the next presidential election could cause, a change of sorts, right? Just given the haves and have-nots. Yeah, listen, looking volatility and drawdowns, not as a time to get out of the market and run for the hills, as they say, but just to realize the nature of a late cycle bull market. Some of the best returns actually happen at this point, but you just got to keep an eye on the horizon because again, these things will shift. It's just we're not there yet, as we clearly laid out. And in this late cycle, not that we're going to adamantly say we're going to do better than last year and the year before, but typically the next year or two of returns are some of the best in the late cycle. So that's pretty much all we have to say. We can take questions that are anonymous if you want to type them. Nobody will see. You can even be anonymous to us if you don't want us to see you asking the question. It's also a reminder to fill out the survey. When you do log out, you'll get a thing that will pop up asking you to fill out. Really helps us, and don't worry, you won't hurt our feelings if you have some, very critical things to say. It just helps us do these presentations better. And we will be sending out copies of the presentation along with the recording to everybody. I think we put up on YouTube now as well. I think that's how we sent it. So, questions? Do we have any questions from anybody? Yeah, I see one has come up here just around Canadian dollar, but I think we touched on that potentially on the predictions. But Jason, just for people that are traveling, potentially, maybe going to the US or, are dealing with the US dollar in their business, just any quick thoughts, not a prediction, but I won't pin you on the forecast, but just some quick
The
thoughts.
forecast, I would say, very similar to last year. It's kind of range bound. We traded from 71 to 74-ish. I think we just continue to do that until we get real clarity on the tariffs, and if we do get the Bank of Canada raising rates later this year, and the Canadian economy is doing a little bit better, yeah, then it breaks out of that 74 range and moves higher.
Okay. All right. I don't see any other questions coming in, so either we did a really good job of answering every single thing that anybody's thinking about, or nobody wants to ask a question. Feel free to email us afterwards, folks, if you had something longer, or always happy to hop on a call. Just want to thank you for joining us.